On face value, the UK grocery market doesn't look like a very attractive investment proposition. It's highly competitive, with 4 full-choice supermarkets, as well as 2 discounters, Aldi and Lidl, who have taken about 20% market share since they first entered the UK in the 1990s. It's also a low sales growth industry. Tesco and Sainsburys, who are the 2 listed supermarkets, have been growing sales around 3 to 5% because it's so mature. It's also a low margin industry, with delivering operating margins of below 5%, which means small changes to sales or to costs can make a big difference to profitability. Despite this, Tesco and Sainsburys have seen their share prices up about 30% last year, and that's because both of these are taking share and improving their investment returns. For Sainsburys, this has been due to its food-first strategy. It's a pretty simple idea that by focusing on the basics of delivering the best value, quality and service, they'll be able to gain more customers. And it's working. The 2 pillars of this have been, first of all, Aldi Price Match, where they've been matching those lowest prices in the market on an increasing range of core goods. That's meaning customers can use it for more of their main shop, and it's starting to break down Sainsbury's reputation as one of the more expensive main grocery shops in the market. The other part is its Taste the Difference own label range, where it's investing in quality and innovation to meet the needs of those customers who are eating at home more rather than going out and trying to have those special occasions. This investment in quality and value is proving to be a really virtuous cycle. By taking share and growing sales, it helps Sainsbury's reduce costs. Those lower costs are also enabling it to invest more in quality and value, as well as be able to collect more data on its Nectar loyalty programme, which helps it identify those areas that customers most value. This is also proving a virtuous cycle for shareholders, where the focus on its core business and improving profitability is enabling Sainsbury's to increase its basic dividend. And it's also returning proceeds from non-core asset sales to shareholders through special dividends and share buybacks. This is meaning that income part of its total return is improving, which is a really important part of its investment proposition. But no investment case is perfect, and the short interest in Sainsbury's still remains quite high. This is partly because it owns the Argos business, which is a traditional catalogue retailer that's now competing with Amazon in general merchandise. Its profitability has fallen, its shares have fallen, and it's the subject of a turnaround from the Sainsbury's management team who are trying to grow sales and cut costs. This is difficult to execute and could be a distraction, but it's also an opportunity if the management team can pull it off and improve profits or sell the business and return those proceeds to shareholders. So investors are watching this part of the business closely. We use Sainsbury's as a defensive exposure for the Milford funds. Stable business models that can provide consistent cash flows and dividends are an important part of a diversified portfolio. And these types of investments become more attractive when share market volatility is higher. We'll continue to monitor Sainsbury's and make sure that it can deliver that virtuous cycle of taking share and improving investment returns to justify its position in the Milford funds.